Silver has got, a nice bid under it, actually. I mean, it really feels firm. And I look forward to your market analysis on this. If you look at both those precious metals, they should be coming off in the summer months, basically, because the establishment will want some cheap stock or to market on their shorts or whatever it might be. It could happen yet, but there's no sign of it. It's just remarkably firm. And I just get the feeling that anything coming into the market is just taken.
So I think what we're seeing in silver, it's, I believe, jumped sufficiently out of their tentacles, of their control, for the price to be determined in the physical markets where you have to own something before you can even sell it. So now I think the same thing is about to happen in gold.
The silver market appears to be undergoing a structural transformation, shifting away from a system historically dominated by leveraged paper contracts on exchanges like COMEX and the LBMA. For decades, price discovery in silver was largely influenced by futures and options trading, which has often been criticized for being disconnected from the underlying physical supply and demand dynamics. However, current market behavior suggests that silver may now be moving beyond this paper-based framework. The resilience of silver prices during what is typically a seasonally weak period, the summer months, is particularly telling. This strength implies that physical demand consistently absorbs available supply, indicating that pricing is increasingly determined by real-world transactions in physical markets, rather than speculative positions on derivative exchanges. According to renowned analysts Andrew Maguire and Alasdair Macleod, a key factor contributing to this shift is the notable reduction in open interest in silver futures, accompanied by growing signs that this interest is not simply disappearing, but transitioning into physical holdings. This trend poses a significant challenge to traditional market participants, particularly large financial institutions that have historically wielded influence through synthetic short positions. Both analysts highlight that silver has effectively jumped the ring fence, moving beyond the control of centralized financial entities that previously managed price levels through paper manipulation. Importantly, this evolving dynamic is viewed as a leading indicator for gold, which is exhibiting similar patterns, such as declining open interest and rising prices, suggesting that it may also be transitioning toward a physical market-driven price discovery model. Alasdair Macleod further underscores the role of geopolitics in accelerating this transformation. China, a long-time accumulator of silver, was a significant net exporter in 2023, with shipments primarily directed to financial centers such as Hong Kong, Singapore, and London, destinations unlikely to reflect industrial demand. However, those flows have recently tapered, indicating a potential shift in policy toward retaining and centralizing physical silver reserves. Macleod interprets this change as part of a broader realignment in global precious metals markets, where physical exchanges, particularly in Asia, are increasingly determining prices, rather than Western derivatives markets. With Basel III regulations placing greater emphasis on physical backing and transparency, this evolving environment could ultimately diminish the influence of paper trading, ushering in a more fundamentally sound and transparent era for the discovery of silver and gold prices. Now, we present the clips from Alasdair's interview with Andrew Maguire. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
If you look at the valuation basis between bonds and equities in America, any way you want, but particularly America, because that's quite easy to chart, the S&P is more highly valued relative to the long bond than it has ever been in history. It is more than twice as overvalued as it was in April 2000. The dot-com boom, more than twice as overvalued. If we see the long bond yield beginning to rise from here, you're going to get an equity market collapse developing, just like Wall Street in 1929. It's going to be another October 29. Now, I don't know when it's actually going to happen because everybody is asleep at the moment. As I think we agreed before we went on camera, so many people are either watching Wimbledon or watching cricket or out on the beach or whatever in this wonderful weather. Nobody's paying any attention whatsoever. And I recognize this on my Substack, along with fellow writers of Substack, they say, well, this time of year is always quiet. You can sort of market and do this and do that and all the rest of it, but forget it. Nobody's interested. And that's where we are. So this is why you sell in May and go away. It's not necessarily because the market's going to collapse. You sell in May and go away because nothing's going to happen until you come back in August, late August, early September. And I think we've got the same syndrome now. But this situation is so stretched that I don't think that it can go much beyond the, if you like, the later stages of this summer. It is so stretched. And interestingly, Andy, from the point of view, looking at what's going on in precious metals, gold is just moving sideways. Silver has got, a nice bid under it, actually. I mean, it really feels firm. And I look forward to your market analysis on this. But if you look at both those precious metals, they should be coming off in the summer months, basically, because the establishment will want some cheap stock or to market on their shorts or whatever it might be. It could happen yet, but there's no sign of it. It's just remarkably firm. And I just get the feeling that anything coming into the market is just taken. So over to you on the market.
Again, silver provides a window. It's obviously, gold is much more complex to follow. The footprints are much easier to read. But the thing is, I think that, and we were talking about 35 resistance. Now that's become support. And in fact, even 36 looks like support. So why is that? And I think what it is that personally, I believe this, and we track our liquidity providers in Asia, and what it's happened, I think that silver has a sufficient open interest, or let's just say the sufficient COMEX open interest and LBMA open interest that has now escaped into the physical markets. I think it's jumped the ring fence. I think they're having very, very much trouble in keeping silver down. And I think it's almost, and to me now, that kind of raises, you mentioned 2020. If we look at gold in 2020, we had 800,000 contracts of open interest. And I know you follow this closely. Now we're around half of that, maybe a bit over half of that. And some of that is momentum short positions. So, and yet, as you know, the gold price continues higher without that open interest. So I think what we're seeing in silver, it's, I believe, jumped sufficiently out of their tentacles, of their control, for the price to be determined in the physical markets, where you have to own something before you can even sell it. So now I think the same thing is about to happen in gold. We're seeing that open interest really dwindling. We see it evaporating. Where's it going? It's not evaporate. It's a finite equation. Where is it going? It's going into the physical markets. So then you've got the unwind of leverage, hence the price increase. So I think that silver is providing the key to what we're seeing in gold, which is it is going to also exit itself from the controls of the LBMA CME, who have been sitting on that between them for 50 odd years. And I think when the physical markets are being determined somewhere else, and you can try and delay Basel III all you want in the US, all that's going to happen is you don't adhere to that. You continue to play paper games. Well, when the liquidity has flowed out into the physical markets, and they turn around and just simply say, give it to us then. And then essentially, unless the COMEX ultimately becomes equally Basel III compliant, every ounce is going to vanish.
That's interesting. The other thing I did notice is that in 2023, China exported an awful lot of silver, and to my mind, was suppressing the market. And the thing that was interesting is that amongst the largest takers of this silver were places like Hong Kong, Singapore, and London, which I would regard as predominantly financial centers rather than photovoltaic manufacturers. Last year, 2024, these financial centers dropped off. There was still a sort of net export from China. I mean, there's no doubt that China, in my view, has accumulated an awful lot of silver. It's been stockpiling it over the years, so it's been controlling the market. But I suspect that's changing. And the thing that's interesting is that perhaps with a very quiet change of policy, I mean, we've seen it with rare earths, very good example. But we're now finding that, silver, platinum, and so on, I mean, suddenly there's a behavior going on there, which we're not all that familiar with.
The recent report highlighting a brewing paper gold crisis as Asia increasingly shifts toward physical bullion underscores significant vulnerabilities in the global gold market. Alasdair explains that the traditional system, wherein central banks lease gold through institutions such as the Bank of England, relies heavily on paper-based transactions rather than the exchange of physical metal. These leases are supported by promises that the bullion will be returned at the end of the term. Still, with mounting demand for physical gold, particularly from Asian markets, central banks are becoming increasingly unwilling to extend these leases and are seeking to reclaim their actual gold reserves. This shift places immense pressure on the paper gold market, which depends on layers of leasing and rehypothecation. As leases expire without corresponding physical gold to back the paper claims, buyers are forced to pay substantially higher prices, which in turn threatens to destabilize broader financial markets through increased counterparty risk across derivative instruments. Alasdair further observes that while gold prices approach all-time highs, investor interest in the West remains surprisingly subdued, with physical gold constituting only a minor portion of portfolios. Conversely, demand in Asia, particularly in China and India, is robust, driven by limited attractive investment alternatives amid low deposit rates, a struggling property market, and volatile equities. Many individuals in these regions are utilizing systematic gold accumulation plans to build physical gold holdings, contributing to an estimated annual flow of over $2 trillion. In contrast, Western portfolios face regulatory and compliance barriers that inhibit widespread adoption of physical precious metals. Alasdair stresses that this moment represents a critical investment opportunity as fiat currencies globally continue to depreciate. Let's get back to the interview.
We know that our exposure, US exposure, portfolio exposure is, square root of nothing virtually. But what it does indicate is the level of interest in Asia in gold. And it's far higher than we think. This bull market, if you like, in Asian terms, have got a long way to go yet. Because, of course, if you look at China, the alternatives are not that attractive. I mean, the banks have reduced their interest rates, so deposit rates there are a waste of time. Property is a busted flush. Stock market is not everybody's flavor. Yet household savings amount to 35% of GDP. I mean, an extraordinary level of savings. This is going into gold. And we're talking about an annual flow of over $2 trillion. So, this is an interesting juncture. And remember also that Chinese housewife, Mrs. Wong or wherever she is, can't rush out and buy dollars or Swiss francs or whatever verboten. So the only thing she can do is tell her bank, open a gold accumulation plan for me and feed, X thousand yuan into it every month. And that's what's going on, I think. And also India too. That's interesting. And of course, both nations, and takes us back to silver, both nations do see silver as money, even though we've forgotten that. And central banks don't get involved with it generally. I mean, PBOC is involved with it because they have the monopoly, if you like, of acquiring and disposing of the nation's silver. But other than that, no central bank is involved with it, or they certainly don't make returns showing that they hold silver as part of their reserves. But I can just see these shortages mounting. And as far as the West is concerned, the underexposure in portfolios is really quite shocking. I mean, you would normally expect in a balanced portfolio to see some mining stocks all similar, representing gold, silver, maybe platinum, or things like that, and maybe copper as well. But nobody's been interested for so long. And with respect to gold, I calculated that all over the world, if you look at, I think we've got something like $300 trillion worth of portfolios. How much gold is in them? It's less than 0.5%. partly because gold itself is not a regulated asset, and therefore your compliance officer jumps down in your neck if you try and buy any. But, they're not yet really piling into ETFs, which, of course, the compliance officer has got no problem with. So I think there's an awful long way to go from that point of view before we even start talking about, well, what's driving gold? The answer is that the purchasing power of our currency is going down. They are not there yet. They don't understand it. They really don't. I tell you, I've got an uphill struggle getting people to understand that it's credit going down, not gold going up.
Yeah. Well, and that's been your message all along. And I think it's, as you say, and I think you also use this, a sovereign as a perfect example. And you say, well, you can exchange that in the 30s for £1, and now what's it, £500? I mean,
600.
Or 600, exactly. But the thing is, I always carry one around in my pocket because it destroys anybody's argument. And they go, well, gold, isn't it volatile? Well, no, it's not volatile. In fact, you see, I'm calling it 500. I should have, if someone had offered me 500, I wouldn't have sold it anyway. I wouldn't have sold it for 1,000, to be honest. Physical gold, I never sell.
You'll be putting it back in the vault. I tell you, I did that once. I was speaking at a function in London. So I travelled up by train to London with a sovereign in my pocket. So in my speech, I sort of waved it around, and I lost the bloody thing.
Oh, no.
I'm not doing that again, I can tell you.
Oh, dear. If somebody was happy. Mind you, they probably didn't recognize it. Probably swapped it for a Mars bar or something, Oh, no, Alasdair, this is fantastic. And it's timely because I think you've drawn attention to some really important things. And I think, obviously gold, obviously you and I always talk about gold or silver. It's physical. We don't talk about paper, silver or gold. And I think this is a huge opportunity. Anyone who thinks, in my view, who thinks that they've missed the boat, that will wait for a pullback. And yet, when you look at your pound, your dollar, your euro in your wallet, I mean, where's the argument? That is debasing rapidly, and it's not. So if I had any spare dollars or euros or pounds, I would just rather quickly as possible put that into gold and silver, because it's simply going to require more of those silly notes to buy the same bit of gold in a month, 2 months, a year from now.
It goes back to the difference between money and credit. Real money is corporeal. I'm talking about the legal position. In other words, it is physical, it is gold and silver, and to a lesser extent, it was copper, though we forget that. I mean, you and I remember coppers. Everything else, all the credit, including currencies, is incorporeal. In other words, it's nothing. It doesn't even exist other than an obligation in the future. I mean, this is why, if you look at the banknote, a Bank of England banknote, you get a script on it, which is getting smaller and smaller, I must say. It's getting into the real small print now. I will exchange this on demand for £1. No, it's now a £10. I mean, we don't have £1 notes anymore. Exchange this for £10, signed by the chief cashier at the Bank of England. And what he's referring to is £10 in gold, if you like, at the official rate, which is still one sovereign equals £1. And as we say, the loss in value of the pound means that a sovereign is now £600. It's the pound that has gone down. And I think all these guys who sort of fiddle around with government statistics about, inflation and all the rest of it, just miss the point entirely. The thing to do is to...
As Asia continues to shift decisively toward acquiring physical gold rather than relying on paper gold contracts, the long-standing paper gold market faces significant strain, especially as central banks grow reluctant to extend bullion leases that have long underpinned liquidity in this space. This evolving dynamic is expected to drive gold prices substantially higher, as the physical demand exposes vulnerabilities in the vast derivatives market based on unallocated and unbacked paper gold. Compounding this, The ongoing global decline in the purchasing power of fiat currencies is prompting investors worldwide to seek refuge in tangible assets, such as gold and silver, which remain the ultimate stores of value amid rising inflation and financial uncertainty. Over the coming months and years, this trend is likely to accelerate, compelling a fundamental shift in how wealth is preserved and protected globally. The implications will extend beyond precious metals markets, potentially triggering broader reevaluations of risk in interconnected derivative markets and pushing a renewed focus on real, physical assets as essential components of diversified portfolios. Share your thoughts on Alasdair's analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the next video. Thanks for watching.